Welcome in, everyone. Ready to dive into the world of private equity.
Oh, absolutely. It's a world full of, well, let's just say intrigue.
Yeah, intrigue's a good word. And we've got a particularly interesting perspective to explore today, right? Warren Buffett.
Yeah.
From his YouTube interview, he had some pretty strong opinions about the industry. And honestly, I'm really curious to unpack it all.
Yeah, me too.
So for anyone listening who's, trying to wrap their head around this whole private equity landscape, I mean, who better to learn from than Buffett, right? Guy's a legend.
When they've done that, seen it all.
Exactly. So let's just jump right in. One of the first things that really stood out to me from the interview was just the sheer amount of money Buffett says is pouring into private equity right now. He threw out a figure, what was it, $3 trillion in buying power?
$3 trillion. It's an insane number.
It's mind-boggling.
Like, to put it in perspective, that's basically the entire GDP of the United Kingdom.
Wow.
And it really underscores how private equity is kind of reshaping the entire financial landscape.
Right, and it made me think, okay, how do they even get that much buying power? It's not like they've actually got $3 trillion just sitting in a bank account.
No. It all comes down to this thing called leverage.
Leverage, okay.
It's essentially a way of amplifying their investment using borrowed money.
Oh.
So let's say a firm has $1 billion to invest.
Okay.
They might use like a 2-to-1 leverage ratio.
2 to 1.
Meaning they borrow another $1 billion, so suddenly they've got $2 billion to play with.
So they're doubling their firepower, essentially.
Exactly. And now scale that up. Imagine trillions of dollars in assets under management.
Yeah, suddenly it makes sense how they're becoming these major players and acquiring companies.
Yeah, they can outbid almost anyone.
It's going to have some pretty significant ripple effects on the market as a whole, right?
Oh, absolutely. For starters, think about valuations. When you have that much money chasing deals, it's bound to drive up prices.
Makes sense.
So it becomes harder for other buyers, strategic acquirers or even other private equity firms to compete. It's like this high-stakes bidding war.
Yeah, I can see how things could get a little out of hand.
Oh, for sure.
And it's interesting because Buffett, he doesn't just stop at the size of the market. He actually goes on to question the way returns are even presented in private equity.
Right.
He even uses the word dishonest. And that's a pretty serious claim coming from someone like him. So what's he getting at there?
Well, it's crucial to remember these funds are judged on their returns.
Right.
There's a lot of pressure to present those returns in the best possible light.
So how does that play out in practice?
Well, this is where the fee structure comes in.
And that's where we get into the famous 2 and 20 everyone talks about.
Exactly.
Yeah.
The 2 represents a 2% annual management fee.
2%.
Charged on the total assets, regardless of performance.
Okay.
And then there's the 20% carried interest, essentially a cut of the profits.
So even if the fund is losing money, the managers are still making bank off that 2%.
Exactly. And this is where that misalignment of incentives can come into play. The manager's primary goal might be to raise as much capital as possible to maximize those fees,
rather than necessarily focusing on getting the best returns for their investors.
Exactly.
That's a bit of a problem, right?
Oh, yeah, big one.
So help our listeners connect the dots here. How does this fee structure, this 2 and 20, potentially lead to the dishonesty that Buffett's talking about?
Okay, so think of it this way. If a manager's pay is so heavily tied to the size of the fund, they might be tempted to make decisions that just prioritize asset growth, even if it's not the best for long-term value creation.
Like they might be more inclined to make riskier investments.
Right.
Maybe overpay for acquisitions just to deploy capital and bump up their fee base.
Exactly, and that's why transparency is so important.
Transparency, yeah.
Investors really need to understand how fees are calculated, how returns are generated, and what the potential conflicts of interest might be.
So it's really about due diligence, isn't it?
Oh, absolutely.
You really got to understand what you're getting into before you commit any money.
Definitely.
But then there's this other layer too, right? The fact that private equity often targets pension funds.
Yeah, that's an interesting one.
And I'm thinking, pension funds, these are people's retirement savings we're talking about, right?
Millions of people.
Why would they be drawn to private equity with all these potential risks?
Well, pension funds are always under pressure to generate returns, right?
Yeah, they got to meet their obligations to retirees.
Exactly. And traditional investments like stocks and bonds, they might not cut it, especially with interest rates being so low. So private equity, with its promise of higher returns, can look tempting.
But it's a gamble, right?
Oh, for sure.
Yeah.
Higher returns always come with higher risk. And Buffett actually shared this story about the Omaha Public Schools Retirement Fund.
Oh, I remember that.
It's a great example of how even experienced investors can get swept up in the allure of those big returns without fully grasping the complexity.
Yeah, it really highlights that even sophisticated investors aren't immune to making mistakes.
And often the presentations are just so slick and persuasive.
Oh, for sure. It's easy to get caught up in the hype and overlook the potential downsides.
Absolutely.
So it seems like it all boils down to understanding those incentives and really making sure everyone's interests are aligned. Which brings us to another key point that Buffett raises, and it's this idea of an inherent incentive problem in private equity.
Yeah, he's really clear about that.
hmm
And it ties right back into that 2 and 20 fee structure.
He even gives this pretty stark quote about it.
Yeah.
He says, if you can raise $10 billion in a fund and you get a 1.5% fee and you lock people up for 10 years, you and your children and your grandchildren will never have to do a thing.
It's powerful, right? Gets right to the heart of it.
Yeah, what are the dangers of that setup from the perspective of the investor?
Well, the danger is the focus shifts. It's no longer about generating returns. It's about maintaining that big pool of assets.
So they're less likely to make tough decisions like selling off underperforming investments.
Right, because that would shrink the fund and reduce their income.
So it's kind of a perverse incentive. Their main goal becomes just keeping the money flowing in.
Yeah, even if it's not in the best interests of the investors.
That's pretty concerning. And to really drive this point home, Buffett uses this really interesting analogy. He compares private equity to a beautiful, well-performing horse that has, a dangerous side.
It's such a vivid image, right?
It is.
On the surface, private equity can be very attractive.
Oh, for sure.
High returns, exclusive deals, this aura of sophistication.
Right.
But just like that horse, there's potential danger lurking beneath the surface.
So the vet in the analogy, he advises the owner to sell the horse when it's behaving well.
Right.
Which seems kind of counterintuitive.
Yeah.
Why sell something that's doing well?
Well, that's what makes the analogy so brilliant. It's all about recognizing that past performance doesn't guarantee future results.
Just because a fund's done well before.
Doesn't mean it'll continue indefinitely.
So how do we apply that to private equity? What are some of the signs that the horse might be about to show its dangerous side?
Well, there are definitely red flags to watch out for.
Okay, like what?
One is a lack of transparency. If the managers are evasive about fees, their strategy, their track record, that's a concern.
Okay, makes sense.
Another warning sign is complexity.
Complexity.
Yeah, if the fund structure, the investment holdings, if it's so convoluted that you can't wrap your head around it,
Yeah,
probably best to stay away.
right.
And finally, watch out for pressure tactics.
Pressure tactics, yeah.
If you're being pushed to invest quickly without having time to do your due diligence,
Yeah. Oh,
that's a major red flag.
yeah, run away.
Remember, never feel pressured into making an investment decision.
So it sounds like it all comes back to doing your homework, understanding the risks. You wouldn't buy a horse without having a vet. Check it out, right?
Exactly. Due diligence is key.
Mm.
Research the managers, their track record, the underlying investments. Don't just rely on the sales pitch.
Don't be afraid to ask tough questions either.
Oh, absolutely.
Right.
If something doesn't make sense, if it seems too good to be true, push back. It's your money. You have every right to know where it's going and how it's being managed.
So be an informed investor. Don't just follow the crowd.
Yeah, exactly. Think for yourself.
I think this is where Buffett's wisdom really shines through, He's emphasizing critical thinking, skepticism, especially when it comes to these investments that promise the moon.
He's urging investors to look past the hype, the quick riches, and focus on the fundamentals.
Yeah, understand the assets, the fees, the people managing your money. Only then can you really decide if private equity is right for you.
Exactly. And if you do decide to invest,
Right.
make sure you understand the terms.
Yeah.
Especially the lockup period.
Oh, yeah. The lockup period?
That's often overlooked.
What is that exactly?
It's the period you can't withdraw your investment from the fund.
Oh, so your money's essentially stuck.
And these periods can be long, several years.
Wow.
So you need to be comfortable with that illiquidity.
It's not like buying stocks where you can sell quickly.
Exactly.
So that's a whole other level of risk.
Absolutely. That's why private equity is considered higher risk.
Mm.
You're locking up your capital for the long haul.
Yeah.
So you got to have a lot of faith in the manager's ability to deliver.
Which goes back to aligning your interests.
Exactly.
You want someone who's in it for the long game.
Someone with a proven track record
Someone who's transparent.
and accountable.
Yeah. In private equity, information is power.
Absolutely.
Yeah.
The more you know, the better decisions you'll make.
The better you can protect your money.
Exactly.
So to sum it all up, Approach private equity cautiously. Be optimistic about the potential, but don't let it blind you.
Do your homework, ask tough questions, and if something doesn't feel right,
Walk away.
walk away.
And of course, remember Buffett's horse analogy.
The next time your horse is behaving well, sell it.
It's a great reminder to always be on guard, even when things are going well.
Exactly. Be prepared for the unexpected.
Okay, so that's a lot to digest, I know.
It is, yeah.
But before we let everyone go, what's one final thought you want to leave our listeners with about private equity?
I'd say the most important thing is to think for yourself. Don't just follow the crowd. Don't get caught up in the hype.
Do your research.
Understand the risks, the rewards, and make choices that fit your goals.
Take control of your financial future.
Exactly. Don't just blindly follow the herd.
And remember, knowledge is power.
In the world of investing, absolutely.
The more you understand, the better equipped you'll be to navigate this complex world.
And make smart decisions that align with your goals.
So there you have it. Private equity, a powerful force.
But not without its risks.
Approach it with caution. And of course, a healthy dose of Buffett's wisdom.
Exactly.
Now, I know you're all eager to apply these insights, so before we dive even deeper, let's take a moment to hear from our sponsor. We'll be right back.
All right, we're back. And I'm still thinking about that horse analogy.
Yeah, it's pretty powerful stuff.
It is, and it's making me think, how do we spot when that horse is about to, get a little wild?
Ah, good question. There are some definite red flags to watch out for when you're looking at private equity.
Okay, give us the rundown.
Well, first off, lack of transparency, always a bad sign.
Right, like if the fund managers are being secretive.
Exactly. If they're dodgy about their fees, their strategy, their track record.
Yeah, it's a big no-no.
Huge red flag. Another thing to be wary of is complexity.
Complexity.
How do you mean?
If the fund structure, the investments, if it's also tangled, you can't make heads or tails of it.
Yeah, I can see how that would be a problem.
That's a sign to steer clear. And then there's the pressure tactics.
Pressure tactics? What are we talking about here?
If they're pushing you to invest quickly without giving you time to do your due diligence.
So basically, if they're trying to rush you into a decision.
Yep, that's a big red flag. Remember, you should never feel pressure to invest in anything.
It's your money. You got to be comfortable with it.
Exactly. Do your homework, ask the tough questions, and if something feels off, trust your gut.
Like you said before, walk away.
Absolutely. So yeah, it all comes back to being an informed investor. Don't just blindly follow the hype.
Speaking of hype, Buffett, he's really hammering home this idea of honesty and integrity, right?
Yeah, he's saying you want to work with people who are straight up about the risks and the rewards.
People whose interests are aligned with yours.
Exactly. So as we're wrapping up here, what's the one key thing you want our listeners to take away from all of this? I'd say the most important thing is to approach private equity with a critical eye.
So don't get swept up in the excitement.
Right. Do your research, understand the incentives involved, and never be afraid to walk away if something doesn't feel right.
You've got the power to protect your financial future.
You do. Knowledge is power, especially when it comes to investing.
So true. The more you know, the better equipped you are to make those tough decisions.
Absolutely. And that's exactly what we're trying to do here. Give you the information you need to navigate this complex world.
So to sum it all up, private equity, it's a powerful force, but
it comes with risks.
Approach it with caution, skepticism, and remember Buffett's wisdom.
Always a good idea.
That's all for this episode's deep dive. We hope you found it insightful, thought-provoking, and maybe even a little bit empowering.
Until next time, keep learning, keep questioning, and keep diving deep.
You know, it's interesting because listening to Buffett, you could walk away thinking private equity is all bad.
Right.
But that's not really what he's saying, is it?
No, not at all.
I mean, clearly there's a reason it's become such a big part of the financial world.
Oh, definitely.
So for our listeners out there, how do you know when it's a good opportunity versus a bad one? Like, how do you spot the difference? When's the time to walk away? Or to use Buffett's words, when's the time to sell that horse?
Yeah, that's the key, isn't it? I think a lot of it goes back to those red flags we were talking about earlier.
Okay, right. Like what specifically?
Well, if the fund managers aren't being transparent about things, if their fees are super complicated or you just don't understand them,
right?
Or if they're putting pressure on you to invest quickly without giving you time to do your due diligence.
Yeah, any of those things should be a big warning sign.
Huge red flag. And in those cases, you got to trust your gut.
Yeah.
You're the one making the decision, nobody else. So don't let anyone pressure you into something you're not comfortable with.
It's your money at the end of the day.
Exactly. And I think this is really where Buffett's wisdom comes in. He's been doing this for so long, he's seen it all.
Yeah, he knows what he's talking about.
And one of the things he really stresses is honesty and integrity. You want to partner with people who are upfront about the risks and rewards.
People you can trust.
Exactly. And whose incentives are aligned with yours.
Makes sense. So as we wrap up this deep dive, what's the one key takeaway you want to leave our listeners with about private equity?
I think it all comes down to this: approach it with a critical eye.
Okay.
Do your research understand the incentives at play? And don't be afraid to walk away if something doesn't feel right.
You have the power to protect your financial well-being.
You do. Knowledge is power, especially in the world of finance.
Couldn't agree more. The more you know, the better equipped you are to make those tough decisions.
Exactly. And that's what we're all about here, giving you the information you need to navigate this complex world.
Awesome. So to sum it all up, private equity.
Powerful force,
Yeah.
not without its risks.
Approach it with caution
Skepticism,
and a healthy dose of Buffett's wisdom.
always a good idea.
That's all for this episode's deep dive. We hope you found this exploration of Warren Buffett's perspective on private equity insightful, thought-provoking, and empowering.
Until next time, keep learning. Keep asking questions and keep diving deep.